Let's bring in Samantha Dart this morning, Goldman Sachs co-head of global commodities research, who has actually been a great radar in helping us navigate the last few months. It's great to have you back. You've been bringing down your numbers, right? Your targets for Brent, at least. Where are you guys?
That's right. We lowered our forecast for Q4 this year from $90 a barrel to $80 a barrel for Brent, and TI just $5 below at 75.
Do you think these levels can hold on the front end for TI?
So that's a very good point right there, because when we think about the path from here, we have Q4 at 80 in our forecast, but we have the average for next year at 75. So when we think about how the prompt is pricing right now in the low to mid 70s, this suggests almost as if the market is already wanting to price in the oversupply we do expect for next year. We do expect a surplus for next year of over 3 million barrels a day.
People say, how did this happen? How did we get so worried about going to 135 or 150 or whatever? People point to the China buyer strike, the pipeline's working, right? SPR inventory is getting drained. Is there something more that we're missing?
I think you hit on a lot of very key points. In addition to that, we did have a lot of headline management. Every weekend it was, okay, the deal is closer, it's getting here. And this certainly had an impact into how willing market participants were to put risk on. But I think, especially when we look at the fundamentals, especially what you mentioned about China, is a huge factor. Even today, when we look at how much crude China is importing, it's still going down sequentially. It's not yet rebounding. So when we think about how quickly crude oil prices are dropping, I think it has a lot to do with that. Flows through the strait are definitely improving. And your imports from Asia more slowly, right? And I think in contrast, when you look at products, when you look at your gasoline, your diesel, jet fuel, it's a little bit different, because on the supply side, we have refinery capacity in the Gulf that has been damaged. So that will take some time to be repaired. So when it comes to products, it's very likely that demand rebounds faster than supply.
How big of an impact is what's going on with OPEC right now? There were headlines this morning that Iraq was considering leaving because of it wasn't accommodating enough to what it wanted to see with production.
Yeah, it's definitely changed how we look at the potential for production growth post this shock. When the UAE left OPEC, we thought, okay, they are going to be freer to increase their production levels, not just to above pre-war levels, but maybe a little bit higher. And they are talking about production targets closer to 5 million barrels a day. So I think this does point to a recovery in crude oil production that can be quite significant. And I think this, again, when we think about how low prices are right now, already back to pre-war levels, there is a little bit of that. We put out that 75 view for average next year, but we do have a downside risk to that. This number could approach even $60 a barrel for Brent if we had, let's say, surprisingly high production, which goes to what you're saying, and maybe stickier losses on the demand side. We saw, again, a lot of demand destruction out of Asia and in particular China. How much of that is going to stick around? And part of that, I think, is structural when we think about how much China is relying on EVs. It's remarkable to see how EV sales have accelerated into the conflict.